Okay, so I think we got it recording, and I am going to open my book here on my screen so I can pay attention to what I'm doing. That always helps. Okay, chapter 5. We are making a big switch now to companies that sell a product called merchandising businesses. Because we, before this, have been only dealing with companies that perform a service for their clients. So the way they made a living was they did work for clients. Hopefully they did enough of that work, they called it revenue, that it covered their expenses, and hopefully they made a profit. But what we're going to do is we're going to actually sell a product. So we're going to compare a service business to a merchandising business. In particular, how their income statements are going to look. Let's say. The income statement for a service business was really pretty simple. Trying to make it small so we can see some stuff on the screen. We would start with revenue, which was the work done. And then we have a bunch of expenses. I'm trying to leave myself some lines because I'm going to need them when I come over here. And then you'd subtract the two, and you'd get net income. That was pretty much it for an income statement for a service business. You had revenue and expenses, so you subtracted them and got net income. Well, over here they have revenue too, but their revenue doesn't come from doing work for a client. It comes from making sales, selling their product. A merchandising business does not make their product. That would get too complicated. That comes very late in our book and what we're going to call Accounting 224 or Accounting 3. So we're going to put that off for a couple of courses before we start making our own products. Right now, we're going to be a store like you would find in the mall. They bring in a product ready-made, slap a price tag on it, and sell it. But when they sell it, the first thing they've got to do is cover their cost. So let's say they bought them for $10. They need to sell them for something more than $10 so they can make a profit. We call that the cost of the item, or specifically the cost of the goods, the products that they sold. So let's go with an example. Let's say we sell 1,000 products. Let's just type it out here so it doesn't fit on the screen. Tell me when you can't see something because I've gone too far off the screen. So we're going to sell 1,000 products, $10 each. That same 1,000 products, each one cost us $7 each. I'm just making some numbers up, but hopefully we're going to do something like that. We're going to buy them for one price and sell them for a higher price. That would mean we'd make $3 on each one.
Right.
If we did the math, it's $10,000 minus $7,000, so we'd end up with $3,000 as our, and the word is gross profit. Just like gross pay. There's going to be a net profit. We're going to call it net income. So that gross profit, the difference between bringing in $10 for each product, 7 of it just goes to reimburse ourselves for what we spent to buy the product. The other $3,000 helps to cover the expenses. So we're going to make a number up and say those are $1,200. So then our company would have a net income of $1,800. That makes sense?
Yeah.
Okay, you're going to have a page just like that in the book. Let's see if I can find the page number for you. Yeah. I'm just trying to find where the page number is. It's like the second or third page in. It's Exhibit 5.1.
Oh, yeah, okay.
And it's done horizontally instead of vertically like I did it, but pretty much the same thing. A service business just has revenues minus expenses, and you get net income. But a merchandising company takes away the cost of the products that they're selling. That gives them gross profit. Then they take away expenses, and that gives them the final net income or net profit. They show you how an income statement would look for a company like Z-Mart on the exhibit 5.2. Just right below there. And of course, that's with all the numbers filled in instead of just explaining the concepts. I'm thinking our best thing to do is jump back and look at how a homework problem will look with that much information. So I'm going to the end of chapter 5 and just looking around a little for a second to see if I can find a problem that would practice just what we've learned so far before we get into all the rest of the stuff that's going to show up in the chapter.
Okay.
I don't know if there's a good one yet. Yeah, it looks like we might have to go a little bit farther before we can do anything. I'll learn a little bit more before we can play around with the homework stuff. Okay, so we've learned about how an income statement looks, but we also got to talk about how the balance sheet looks for a merchandiser versus a service business. So our balance sheet is very similar. You only have one additional asset that a merchandiser would have that a service business didn't have, and that is called merchandise inventory. It's sometimes just called inventory. We have this new account that represents all the inventory we have in our store, because obviously that's something our business owns. It's going to amount to a lot of money for a store. That's where a lot of our assets are, is having all that stuff on our shelves. We had to spend a lot of our money to buy that stuff that we hope we can sell to our customer for a pretty good price and make a profit on it. So merchandise inventory is an asset. Let's see if we can stretch this out a little bit and unmerge it for a minute. And we'll make it into a T account. There we go. So merchandise inventory, because it's an asset, the debit is where its plus side is going to be, and the credit side is where its minus is going to be, just like all the other assets. So the things that are going to happen on the debit side are when you purchase more merchandise. Every time you buy more from your supplier to bring it into your store to put on the shelves, you would debit merchandise inventory. And every time you sell it, you're going to credit it, because you'll be getting rid of your inventory. You'll be going out the door with customers. Mm-hmm. That make sense? Yeah. Okay. So we're going to look at some journal entries, and these are great ones to keep track of, like actually make a little cheat sheet of when you buy merchandise, this is the entry you make. Then you won't be stuck going, ooh, which accounts, or trying to remember. You can just have a reference sheet for it.
Okay.
And where you're going to want to go is page 194. So when you buy merchandise, you're either going to buy it and spend cash right then, hand your supplier money, or you're going to tell your supplier, ship me a case of that stuff and an invoice, and I'll send you payment. In other words, you're telling them, put it on my account, I'll pay you later. So there's only two ways that entry can be. When you purchase merchandise, It can be for cash. That would be merchandise inventory debited. And cash credited. Or you'll have the same exact entry. Well, that's interesting. I don't know what I managed to do there. Or it'll be accounts payable if you buy it on account. So every time you buy merchandise, it's either going to be that you give them cash or that you tell them to put it on your account. Those are the only two choices.
Okay.
So your job will be to read the story problem to decide which one to use. So on page 194, right below the heading that says accounting for merchandise purchases, it gives you the little story. It says, to illustrate, Z-Mart records a $1,200 cash purchase. So that tells you that you're spending cash on that day, and thus your credit's going to be to cash.
Mm-hmm.
And if it had been the other way around, you would be looking at an entry that you would see on the next page, 195, I think it is.
Under accounts payable.
Yeah, it says merchandise inventory accounts payable $1,200.
Yeah.
So it's the same thing. They're just kind of changing the story. Well, what if we didn't pay cash? What if we paid by telling them we'll pay them later? The thing that happens when you have to pay later is eventually you do have to pay. So there'll be a second entry where here, there's no more to do. You paid them with cash, you're done. Here, you charge it, and then there'll be an entry to pay them. Sometimes, so you can pay off the stuff you purchased. Good accounting language there. Okay, when you pay off the stuff you purchased, sometimes the place you bought it from will give you a discount. They'll say, if you pay us really quickly, you can save a little on your bill. You don't have to pay us the whole balance. Or if you just pay in the normal amount of time, you just pay the whole balance. The way they do that is they give you credit terms. So on page 190, I think it's 5, right above the November 2nd entry where it does merchandise and accounts payable,
Mm-hmm.
you see a terms, and it looks like 2/10, comma, N/30. Looks like gobbledygook, but it means 2% off if you pay in 10 days. Or the whole balance is due in 30 days. So you're telling your customer they have 30 days to pay. So that we were the customer. We bought merchandise from this place. And they're telling us we have 30 days to pay. But if we pay really quickly, like in 10 days, we don't have to pay the whole $1,200. We can save a little. We can save 2%.
Okay.
So the entry that you see right below there on November 12th, we did pay quickly. From November 2nd to November 12th, that's within the 10 days, so we get to save a little. So we write our check for only $1,176 because we figured 2%, that's $24, so we get to save $24, so we only have to write the check for $1,176. But we
credit, and then we also credit the merchandise inventory?
Yep. That one's going to seem a little weird. The cash hopefully makes a lot of sense and why we wrote the check for what we did.
Yes.
Accounts payable, the debit has to be for the whole amount because it's going to wipe out the credit we put in accounts payable on November 2nd. We put a $1,200 credit on November 2nd.
So you're doing two separate transactions for one.
Right. When we bought the stuff, it was on November 2nd. We did that entry. We put $1,200 in accounts payable on the credit side back on November 2nd. And then now on November 12th, we're debiting accounts payable for $1,200. Well, when that goes into the accounts payable account, which is on that same page, you can see that 1,200 on the debit side, 1,200 on the credit side. Those wipe each other out.
Uh-huh.
And it makes the balance of zero, which is exactly the truth. We no longer have a liability. We don't owe anybody anything because we just paid off our bill.
Right.
But if we had only done $1,176 to accounts payable, it would have left the accounts payable looking like we had a $24 balance. They wouldn't have wiped out. It would have left $24 balance in there, kind of screaming at us, hey, you still have $24 more to pay. So because we need to wipe out accounts payable all the way to zero, we debit it for the same amount that's in there, $1,200.
So how does that balance off at the end with the merchandise inventory?
Right. If you look over at the other T account for merchandise inventory, you see the $1,200 went in there on the day we bought the stuff, November 2nd.
Yeah.
And then on November 12th, the only thing we do to it is put a $24 credit, the amount of the discount. So in other words, we're reducing merchandise inventory by $24. Not because we have less inventory. We have the same number of products that we did before. But now merchandise inventory is telling the truth. It is saying the balance is $1,176, which is the true amount we spent to buy that stuff. If we hadn't done it, that account would say, we spent $1,200 for this merchandise. And that really wouldn't be the truth. It's what we thought we were going to spend until they were nice to give us a discount.
Right. Okay.
So now that we know there's a discount, we're going to have to go in there and go, whoops, that's a little too much money. We're taking the 24 back out of there. So it tells the truth.
There's no cash T account for this?
I'm sorry?
There's no cash T account for this?
They didn't bother to show it just because the only thing happening to it was to spend $1,176. And so to save space. But you would post to a cash T account.
Oh, okay.
I think they just wanted to zero in on these two accounts that they figured the students would have the most confusion about.
Okay, makes sense. But that the cash account would be the same way.
Right. Except that you wouldn't have put anything in back on November 2nd.
Right.
You would just show the $1,176.
Okay. Okay.
Okay, so when you're buying stuff, we had two choices. You could either buy it for cash or buy it on account.
Mm-hmm.
When you pay for it, you either pay for it with a discount or you pay the whole balance.
Mm-hmm.
So with the discount, just kind of making notes here. I know we just talked about it, but just safer this way. We're going to accounts payable debit. Move that over for the whole balance. Then we're going to do merchandise inventory for the amount of the discount. And we're going to do cash for the balance minus the discount. Does that make some kind of decent notes, or is that going to be more confusing?
That makes sense to me. I would say for the cash amount paid, maybe.
Okay, sure. Okay. So we talked about with a discount, but there's going to be times when, even though they give you the 10 days to pay, something happens. Either somebody loses the bill and forgets to pay it, or we just didn't have the money, so we didn't pay in 10 days. We just waited out 30 days and paid it then. So if there's no discount, or we just don't pay it quickly enough to get the discount, it would just be accounts payable, like we said, for the whole balance, and cash for the whole balance, because we would have to pay the whole $1,200.
So where does the merchandise inventory come in at?
There would be no $24 discount. If we didn't get the discount, we wouldn't have to go to merchandise inventory and adjust it for anything, because there would already be $1,200 in it, and that ended up being how much we paid, so it's correct. Doesn't need us to adjust it at all by taking any discount amount out of it.
So when we would do the November 2nd merchandise inventory $1,200, cash $1,200.
No, merchandise inventory and accounts payable.
When we
Here, let me
purchased
put this up here.
When we
This
purchased it on November 2nd?
Yeah, let's see. There we go. It's kind of coming into focus. On November 2nd, we can either pay cash or accounts payable. But if we pay cash, we're done. There's no discounts, there's no nothing because we're paid right then. So now the story is kind of looking at, well, what if they do charge it and then get a discount? If you get a discount, you have to make an entry at the time of the payment. We looked at this one where they do take the discount.
Oh, but if you don't, then
But if like they paid November 22nd and 20 days later, they would have missed the chance to get the discount. So they would have made an entry of just accounts payable cash.
So the only time you would have to record a second entry is when you have the discount.
No, you're going to have, let's go back to the Excel for a minute and see if we can, let's see.
Because I'm trying to figure out without the discount, wouldn't you still have to put that you bought merchandise? So wouldn't it still be a T account for that?
Yes, you will have this entry. Let's say if you buy an accounts payable, say you're going to pay for it later, you have to make this entry. That'll put like $1,200 or whatever the amount is in merchandise inventory.
Uh-huh.
And it'll put $1,200 in accounts payable waiting to be paid.
And then 30 days later.
And yep, you'll have to make an entry to take it out of accounts payable to say, I've now paid that.
Okay.
That's going to be accounts payable cash.
Okay. Makes sense. Now I'm
moving. Yep. This one has to have a second entry. Okay. Where the cash one, since you paid for it right that day, there's no additional entry needed.
Okay.
Okay, so we've taken care of buying stuff, or most of the issues with buying stuff. I'm going to put the textbook back up there so you can see it with me. Okay. The next thing we're going to get into is returns. And it's going to come up a lot more than it really happens in real life because they're trying to teach you about it. So it's going to seem like every time you buy something, you have to return some of it. But that's the way the stories are going to go. You purchase some stuff and you get it to your business or they ship it to you and you open the box and there's something wrong. So then you end up sending stuff back to your supplier and saying, you know, take this off my bill. The stuff isn't what I ordered or it was damaged or something. So we're going to learn to record returns. Almost every time in the textbook, the return will happen in between the day you buy it and the day you pay for it. So those last ones were November 2nd and November 12th. It would happen in our textbooks, story problems, like on the 6th or something between those dates.
Okay.
And when you do a return, I'm going to skip allowances for a minute. I'll come back to an allowance, but we're going to look at a return.
Okay.
So we're going to look at the whole story here. June 1st, we bought some merchandise from this supplier. They gave us 10 days to save some money, or we had 60 days just to pay the bill. It looks like the merchandise came on June 3rd, and we looked at it, and there was a problem with some of it, not all of it. Only $100 worth of the stuff had damage to it. Okay. So we sent back 100 out of the $1,000 worth of merchandise. So we didn't send back the whole stuff, just a small portion of it. So we owe $900 now that we sent some of it back. And you see what the entry looks like when we return stuff? It's like a reverse sale.
Okay.
It's really all we're doing. We're flipping the sale over. We're saying, no, accounts payable needs to go down now because while we thought we owed $1,000, we're shipping this stuff back. So we're going to drop our bill down by $100. And the amount of stuff we have in inventory also needs to go down. because we don't have $1,000 in inventory anymore. We're going to take $100 out of it.
Okay.
Then when it's really time to pay the bill, and they're going to pay in 10 days, so they're going to try to get the discount, we have that same accounts payable, merchandise, inventory, cash. The same thing we saw when we were looking at it before for what you do when you pay the bill.
Okay.
The only thing you got to be careful of is the 2% discount is not 2% of $1,000 because you don't owe $1,000. It's 2% of your new balance,
Okay.
900.
Makes sense.
That's usually the biggest thing students miss is they forget that we returned some stuff.
Okay.
Okay.
Yeah.
So returns aren't too bad. Just watch for them and remember when you get down here that what is your balance. Sometimes the problem will just say June 11th, we paid our balance. And they don't tell you the dollar amount. So they leave you to have to reread the problem again to go, okay, it was 1,000, then I sent back 100. Oh, my balance is 900.
Mm-hmm.
And then I can keep going. So if they're mean to you and send you back to the story problem, just take time to make sure you look for any returns.
Okay.
Allowances are kind of different. When you have an allowance, you're telling the seller, there's something wrong with this merchandise here. I opened the box and it was dented or scratched or whatever. But you decide to keep the stuff. You just don't want to pay full price for it. So that's Z-Mart's case. They talked to the supplier and said, some of this merchandise is damaged. I want you to take something off my bill. And the supplier says, take $300 off your bill. So that's the entry here. We didn't send any merchandise back, but we are reducing the dollar amount in the merchandise inventory account because we have less merchandise now. We have the same amount of merchandise, we have paid less for it. Does that make sense?
Yeah.
Okay. Are you still able to see the screen?
Yeah.
And to see the textbook?
Uh-huh.
Okay, good. Sometimes it gives me a box around letting me know that this is what the student's able to see, but sometimes things go wrong, and I just don't want to be talking and pointing to things and find out I'm pointing to something you can't see. Okay, so now we've pretty much covered just about everything when we're the purchaser. We've got one more thing, and that's shipping and handling. That's another thing that kind of leave out in the early parts of the book, because we buy something and we just spend $10,000 for a piece of equipment. We never think about shipping it to us and how much that's going to cost.
Mm.
So you're going to see words that begin FOB. And you can see here it says free on board. It means that as the stuff goes from the seller to the buyer, and in our case, we're the buyer, the things as they're being transported, who owns them? When do we take over ownership of them? When does the seller give up ownership of them? What happens if the truck's in an accident? Whose stuff is it? FOB shipping point means the title transfers or ownership transfers right as soon as it leaves the seller. So as soon as it leaves the seller's back door, it becomes property of the buyer. It also means that the buyer is responsible for paying for the shipping.
Okay.
So when the buyer has to pay the shipping, the buyer is going to make an entry like this. Merchandise inventory for some dollar amount, whatever it costs for the shipping. And generally they pay the shipping in cash. So they would just credit cash. Because they're probably not writing this check out to the seller. They're writing it out to whatever trucking company.
Oh, really?
Yeah.
Okay.
Sometimes it'll happen differently, but a lot of times in textbook land, when you buy stuff, there'll be a separate entry where you're writing a check or spending some cash for the shipping, and it's going to go not to the seller, but to some third party.
Okay.
And if it says FOB destination, it means that the title passes once the merchandise reaches its destination, which means when it gets to us. It becomes ours only when it arrives at our door. So that entry would be made by the seller, and they call it delivery expense.
Okay.
It's a cost they pay for to ship their stuff to their customers if they offer it that way. And that's a part of the negotiation when you're talking to your supplier, because it's going to change your price. If your supplier is selling it to you at a good price, but then they want you to pay shipping, you have to wonder, oh, is this still a good price, or should I go to that other place down the road and get my stuff where they're going to pay the shipping? So it's just something to consider in it. And some of your story problems will have you making journal entries to pay for the shipping.
So the delivery expense for the seller would be when the people were buying the merchandise from buy or pays for the shipping?
No, this is opposite. The top one is when the buyer has to pay for the shipping.
When we
The bottom one is when the seller has to pay for the shipping.
Okay.
So it's one or the other. And the way you'll tell is your story problems will say FOB shipping point or FOB destination.
Okay.
And they just show you an example journal entry there at the bottom. Merchandise inventory cash. And yeah, it says Z-Mart's entry to record a freight charge from an independent carrier when they were doing FOB shipping point. If they had to buy something that was FOB shipping point, they'd have to pay the shipping, and they would make a $75 entry like that.
Okay.
Now you really do have everything for shipping, or everything for purchasing. So you're going to see story problems in the back that are all about, let's go out there and see if I can find some of them. The back of the chapter talks about doing journal entries and doing some calculations, but recording purchases. So this hasn't happened to be one of your homework ones, but you'll have problems like this. Prepare the journal entries. On November 5th, we purchased some stuff, and they told us we had time to pay. So we know it wasn't with cash because they gave us 60 days to pay. And then the 7th, we returned some stuff, and on the 15th, we paid the rest. That looks very much like that 1-3 journal entry box that we were looking at in the chapter.
Yes.
Okay. That's what I'm saying. There'll be a real pattern to these. You should be able to get like a sample journal entry in your notes for each of these so that you have something to reference. And then we're going to go on and talk about how to record it when we sell our merchandise. And there'll be sample story problems just like this one on the screen where we're recording sales. So at times when you're reading the stories, you're going to be the buyer, and at other times you're going to be the seller. Because if you run a little store, you've got to be a buyer to buy stuff from your suppliers so that you get merchandise in your store, but you also got to be a seller. That's how you make your living, is you sell the stuff that's in your store to your customers. So that's where we're going next. 199 starts the discussion of selling stuff.
Okay.
And again, there's 2 ways to sell it. Most of the time, you're going to sell it on account. Most of your customers are not going to hand you cash right away. They're going to tell you to put it on their bill. And that's what you're seeing here on November 3rd. $2,400 worth of merchandise. That's the price you charged your customer for the stuff. Went into accounts receivable and sales, because that's our revenue account. But every time you make a sale, it's going to take 2 entries.
Okay.
One is to record the sale.
Okay.
The other is to take the stuff out of inventory. Because otherwise your inventory is going to, the account's going to look like you still own that merchandise. Even though the merchandise just left with that customer.
Right. Okay.
But you notice the dollar amounts. This is the same story. You're still recording the same sale. But this one says 12 or 2,400 and this one says 1,600.
Right.
This is our cost that we paid for the stuff the customer just took.
Gotcha.
But we charged the customer $2,400 for it.
Makes sense.
So you can see we made an $800 profit.
Yeah, that makes a lot of sense.
Okay, so this is what you do when you make a sale. The only thing that could possibly be different is you would come up here and put cash instead of accounts receivable. So if the customer handed you $2,400 right then in the checkout lane, you would put cash instead of accounts receivable.
Okay.
But otherwise, same. So just read carefully in the story whether the sale was on cash or credit.
Okay. Will there ever be a time where we can sell stuff on discount?
I'm sorry, say it again.
Will there ever be a time where we sell stuff on discount?
Yep, that's where I'm going next.
Okay.
There you go, next page. We're going to tell the customer the same thing. They can take time to pay and get a discount.
Okay.
So they're going to start a story and say on November 12th, we sold some stuff to a customer. It was $1,000 worth of merchandise. There would be 2 entries, but they're focusing on this one right now.
Okay.
Wow, this seems like that's a long time. But the 60 days, if the customer decides, no, I don't want the discount, this would be your entry. The customer gives you $1,000 to finally pay off that purchase that they made from us, and we'd wipe out their accounts receivable because their balance with us is now 0.
Okay.
Or the customer could take the discount and we would make this entry.
Okay. So there will never be a time where the customer gave me cash up front and I offered them a discount?
No, because you could theoretically have done something like that, said, if you pay me cash right here today, I'll let you pay less. But we don't see any of those in the story problem.
Okay, awesome.
It'll always be just whatever the sticker price is on the day of the sale, or you can take some days to pay and possibly get a discount.
Okay, gotcha.
Then, of course, just like with us, sometimes our customers return stuff to us. So how do we record the return? Returns also take 2 entries. One, you've got to take the stuff off their bill. So you've got to wipe their accounts receivable off by $800, the amount they returned. But you also have to put the stuff back in inventory, because now that the customer brought it back, it's going back on your shelves, so you have more inventory than you did before they came back with the return.
Makes sense. Okay.
Okay, you can make the assumption that anytime a customer returns the stuff, that it's not messed up. They just took from the wrong size or the wrong color, just decided they didn't want it. So you can bring it back, put it on the shelf, and sell it to somebody else.
Okay.
And yes, in real world, it could very easily have been damaged, and we wouldn't be able to resell it. But they're trying to keep the story problems kind of simple. So.
Right. Okay.
Just a second. I'm going to talk to my son for just half a second.
That's good.
I will be right back with you.